All right, let's dive in. It looks like you've been doing a ton of research on mechanical trading systems, and I'm really intrigued by this idea of blending trader psychology with technical analysis. What really jumped out at you from all the stuff you've been reading?
What's fascinating to me is how much emphasis is placed on understanding yourself as a trader. Like, before you even think about strategies, one book breaks it down into these three trader personalities: trend followers, mean reversion traders, and short-term traders. It argues that each one has its own strengths and weaknesses, and even ideal timeframes for trading.
So before we even get into moving averages and oscillators, we need to figure out what kind of trader you are. Are you a buy and hold trend follower? Do you like to zigzag with mean reversion? Or are you all about those quick short-term trades?
Right. It's like self-awareness is the key. And a lot of people think of mechanical systems as these get-rich-quick schemes, but this author really pushes back against that. He's all about robust systems that deliver consistent returns over time, not overnight riches.
Okay, so let's back up for a second. What exactly is a mechanical trading system? We're not talking about some robot picking stocks for us, right?
No, not quite that sci-fi, but the idea is to take emotion out of the equation. It gives you very specific rules for entry and exit, managing your risk, and sizing your positions. No more guesswork or gut feelings, especially when the market gets crazy.
We've all been there, letting our emotions take over and making impulsive decisions we regret later.
Exactly. And that's what makes this connection between psychology and technical analysis so interesting. One of the sources argues that markets aren't totally random. They're driven by human behavior, and those patterns of behavior can actually make things somewhat predictable.
Wait, so you're saying it's not just like flipping a coin, there are actual patterns we can look for?
Well, exploit might be too strong a word, but yeah, there are definitely patterns that tend to repeat. Think about resistance levels on a stock chart. Those are like price ceilings the stock struggles to break through. They tell us a lot about where traders might get greedy or fearful in the future, and that makes those patterns more likely to repeat.
So past performance isn't a guarantee, but it gives us clues about trader behavior. And this is where those trader personalities come in, right?
Right. Like, trend followers need the discipline to ride those long-term trends and ignore the short-term noise. They look for signals that show momentum, things like moving averages.
And they're the ones who are okay with buying high and selling higher, which feels so counterintuitive to a lot of new traders.
It does, doesn't it? But think about a stock like Apple. If you bought it 5 years ago when it felt high, you'd be pretty happy with those returns now. The book even mentions the 200-day simple moving average. It's a simple but classic indicator for a reason.
Right, the 200-day moving average is like the granddaddy of trend indicators.
Totally. Now, on the other side, you have mean reversion traders. They're more like zigzaggers, looking for prices that have swung too far in one direction. They're betting those prices will snap back toward an average.
So it's like when you stretch a rubber band too far and then it snaps back?
Perfect analogy.
Hmm.
And they use things like RSI or Bollinger Bands to identify those unsustainable extremes. But these systems can be tricky. You're trying to pinpoint those exact turning points, which requires more feel.
A little more art than science, maybe?
Yeah, it's a delicate balance. Now, the third personality type, short-term traders, those are a whole different breed.
Those are the ones who love the fast-paced action, right? Always looking for the next quick trade.
Exactly. And they need to be able to think on their feet, process information quickly, handle the pressure. We're talking minutes or even seconds here.
Wow, I can only imagine. What would you say are some of the biggest challenges they face?
Liquidity is huge. Being able to buy or sell quickly without causing huge price changes. And volatility. There has to be enough movement for those small, frequent trades to be profitable. Plus, burnout's a real risk. It takes a lot of energy to trade like that.
I bet. So we've got these three personalities. Is there like a personality quiz in one of these books that can help us figure out which one we are?
No formal quiz, but there's a chapter that lays out the traits of each style. Strengths, weaknesses, what you're looking for in your trading. It encourages you to think about your own personality. What are your strengths and weaknesses?
So the first step to building a system is actually understanding yourself.
That's what this book argues, yeah. It's about aligning the system to your natural tendencies.
Makes sense. So once we've done some soul searching, what are some things to consider when we actually start designing a mechanical system?
Well, data integrity is huge. The author uses the phrase garbage in, garbage out, meaning you can't build a good system on bad data. And he's not just talking about typos. He gets into some really subtle data errors that can mess things up.
Okay, like what What kind of garbage should we be watching out for?
Well, think about something called survivorship biases. Let's say you're backtesting a system on a list of stocks that have done well over the past 10 years. The problem is that list only includes the survivors, the companies that are still around. All the companies that went bankrupt or got delisted are gone. Your system might look amazing, but it's only been tested on the winners. You know what I mean? Not the full picture.
Ah, so your system could be perfectly tuned to a distorted version of reality.
Exactly. And that's just one example. There's also look-ahead bias. That's when you accidentally use information in your backtest that you wouldn't have actually known at the time. Even small errors like this can totally invalidate your results.
So bad data can lead to some pretty spectacular blowups.
Oh, yeah. He shares some stories of traders who built these seemingly brilliant systems, but they fell apart in the real world because of bad data. It's a good reminder that data is the foundation.
Makes sense. So data integrity is step one. What comes next?
Backtesting. You got to take your system's rules and see how they would have performed on historical data. It's like a simulation. But you have to be really careful not to fall into the trap of curve fitting.
Yeah, we've all heard those stories of traders creaking their systems until they look amazing on paper, but then
They crash and burn in live trading. That's curve fitting. You fool yourself into thinking you found the holy grail when really you've just over-optimized the system to fit the past perfectly. It's like training a dog to do tricks only in your living room. Take it outside and pick.
yeah, good luck with that. So how do you avoid that trap? How do you know if your system is legit or just a product of curve fitting?
The trick is to balance optimization with making sure your system is robust and adaptable. One technique is called out-of-sample testing.
Okay, break that down for me. Out of sample testing. What is it and why is it so important?
It's pretty simple, actually. You take your historical data and you split it into two sets. You use one set to develop your system, and the other set is like a hidden test. You only use that second set after you've finalized your system's rules on the first set.
So it's like giving your system a pop quiz with brand new material.
Exactly. And if your system can pass that quiz, meaning it performs well on both sets of data, it's a good sign that it's robust. It's not just a product of curve fitting.
I like that. It has to prove itself in a whole new environment.
Right. And that's just the beginning. He goes into a lot of detail on backtesting techniques, optimization, statistical tools, all sorts of stuff to validate your system.
Sounds like we're about to get into the weeds, but before we do, can we go back to something you mentioned earlier, that idea of a trading philosophy? What's that mean exactly?
Oh, yeah, he's big on that. He says you can have the most brilliant system in the world, but if it doesn't align with your personal philosophy, you're going to struggle. Your philosophy is like the compass that guides you.
So it's like your set of guiding principles, your mission statement for how you approach the market.
Exactly. It's defining your core beliefs about the market. Your risk tolerance, your trading style, your goals. You set your boundaries before you start developing the system.
Laying the foundation before you start building, huh?
Exactly. It helps you stay focused and avoid chasing those shiny objects that distract you from your goals.
I can definitely see how that would be helpful, especially when the market is being its usual crazy self.
Oh, for sure. He actually provides a template for creating a trading philosophy statement, which is really useful. And he encourages you to revisit and refine it as you gain more experience and as you evolve as a trader.
So it's not something you just write once and forget about.
Right. It should evolve along with your understanding of the market and yourself.
Okay, so we've covered data integrity, the importance of backtesting without curve fitting, and having a clear trading philosophy. What's next on the checklist for building a powerful mechanical system?
Optimization. Tweaking those little parameters of your system like look-back periods, overbought, oversold thresholds, position sizing rules. You're trying to improve its performance.
But doesn't that sound like a slippery slope towards curve fitting?
You're right. It's a fine line. He spends a lot of time in the book on this tension between optimization and robustness. You can easily trick yourself into over-optimizing.
So how do you walk that tightrope? How do you optimize effectively without falling into that trap?
He gives a lot of specific techniques and guidelines, but one of the most important things is to focus on optimizing for robustness, not just raw profitability.
Okay, so in a practical sense, what does that look like? What's the difference between optimizing for robustness versus just trying to maximize profit?
It's about building a system that performs well in a variety of market conditions, not just the specific historical period you happen to be testing it on. He argues it's better to have a system that generates moderate returns over a long period than something that's brilliant sometimes but then blows up later.
Slow and steady wins the race, huh?
Exactly. And this is where those out-of-sample testing techniques are so helpful. You can really test your system's adaptability. It's about finding that balance between performance and handling whatever the market throws at you.
Like designing a car that can handle smooth highways and bumpy back roads.
Perfect analogy. And there's so many other techniques he covers, like walk-forward analysis, Monte Carlo simulations, sensitivity analysis. It's all about making sure your system is reliable.
This is getting pretty technical. I want to take a step back for a second and talk about the human side of using one of these systems. I imagine it can be tough for some people to hand over their trading decisions to a set of rules.
You're absolutely right. He talks about the psychological side a lot. It can be hard to trust a system, especially when it's telling you to do something that goes against your gut instinct.
It's like surrendering control to an algorithm.
Right. Takes trust and discipline, especially when you hit losing trades. Because even the best systems will have losses. It's about trusting the process, not getting hung up on every single trade.
So detaching from the emotional roller coaster of individual trades and focusing on the bigger picture?
Exactly. And he gives some really helpful techniques for cultivating that detachment, like focus on following the rules meticulously, even when it feels wrong. Treat it like a scientific experiment.
That's an interesting way to think about it. So it's less about fear and greed and more about a scientific, detached mindset.
Yeah. And it can be freeing for a lot of people.
Hmm.
He talks about how, for some traders, using a system like this is almost therapeutic. It helps them break out of those bad habits and destructive emotional patterns.
That makes a lot of sense. The system gives you a framework for making rational decisions, even when the market is going haywire.
Right. He doesn't sugarcoat it, though. He's very clear that this is hard work. He even has a whole chapter on the challenges: dealing with losing streaks, fighting the urge to tinker with the system, managing the self-doubt.
So this isn't just plug and play. It's about understanding yourself, managing your emotions, and having the discipline to trust the process.
Exactly. He makes the argument that it's not just about improving your trading, it's about personal growth. Yeah, it can really change things up. He actually uses this interesting analogy. He talks about how in nature, even tiny genetic variations can lead to huge differences in a species.
Oh, interesting.
So just like those tiny genetic differences determine if a plant can thrive in the desert or the rainforest, these little parameter tweaks can make or break your system in a bull market versus a bear market.
That's a cool way to think about it. So by diversifying, even with these little variations, you're kind of hedging your bets against whatever the market decides to do.
Exactly. No system is perfect all the time, right? So spreading your risk with multiple systems gives you a better chance of making money in different market conditions.
Okay, that makes sense. So we've talked about trend-following systems, managing risk, and diversifying. Let's switch gears to mean reversion systems. These are the ones that aim to profit from those moments when prices swing too far in one direction, like a rubber band, and then snap back.
Right. These are for the traders who like to spot those extremes and go against the crowd. The contrarians, you could say.
So how do these systems actually work? What are some of the key things to look for?
Well, one of the most popular indicators is the RSI, the Relative Strength Index. It basically measures how strong recent price changes have been to tell you if a stock is overbought or oversold.
So it's like a way to gauge the market's enthusiasm and see if things have gotten out of hand.
Yeah, exactly. Think of it like a thermometer. When the RSI gets too high, like above 70, it suggests that maybe things are overheated and due for a pullback. And when it gets too low, below 30, maybe it's oversold and ready to bounce back up.
So it's like that pendulum swinging too far to one side. It's got to swing back eventually.
Right. He even uses the dot-com bubble as an example in the book. Back then, tech stocks were going through the roof. The RSI was signaling that things were way overbought, but people got caught up in the hype and ignored it.
Ouch. I bet a lot of people learned a hard lesson there.
They did. And he explains how you can use the RSI to create actual trading signals, like a simple system could be sell when the RSI goes above 70 and buy when it goes below 30.
So you're basically fading those extreme moves, betting they'll come back to a more normal level.
Exactly. But he's careful to point out that even the best indicators can give you false signals, especially when the market is choppy or moving sideways.
Right, so you can't just blindly follow it. You need to use some common sense and see what's happening in the broader market, too.
Absolutely. He really stresses that. No indicator is perfect in isolation. You have to combine them, understand the market environment, and use your own judgment, too.
So it's like a blend of art and science.
I like that. He even suggests that for some people, using a mechanical system based on something like the RSI can actually improve their intuition over time.
Oh, interesting. So instead of just relying on your gut, you're kind of training your gut to recognize those patterns that the RSI is showing you.
Yeah, exactly. It's like you're learning the market's body language by studying its vital signs.
I love that.
Yeah.
Okay, so we've talked about the RSI. What other indicators are useful for mean reversion trading?
He talks about Bollinger Bands, which are another popular tool for seeing those extremes, and also volatility.
Oh, yeah, Bollinger Bands. I've seen those on charts. They kind of look like envelopes surrounding the price.
Yeah, exactly. And the width of those envelopes changes depending on how volatile the market is. When things are wild, the bands widen. When things are calm, the bands narrow.
So they're like a dynamic measuring stick for volatility.
Yeah, that's a good way to put it. And traders use these bands to figure out where to buy and sell. For example, a simple system could be buy when the price touches the lower band, sell when it touches the upper band.
So you're buying when the price seems oversold relative to its recent volatility, and then selling when it seems overbought.
Precisely. You're betting it's going to move back towards the middle of those bands.
But doesn't that mean you're sometimes buying when the price is going down and selling when it's going up? That seems counterintuitive.
It does, right?
Yeah.
But that's mean reversion for you. You're basically going against the current trend, betting that it's gone too far and has to reverse.
Not for the faint of heart.
No, it definitely takes confidence.
Okay, so we've got RSI and Bollinger Bands. Anything else?
Yeah, he also covers the stochastic oscillator. It's another momentum indicator, helps you spot those overbought and oversold conditions. It compares a stock's closing price to its price range over a certain period.
So similar to the RSI, it's looking for those extreme moves that might be ready to reverse.
Exactly. The idea is that if a stock is in an uptrend, it'll usually close near the high of its recent range, and the opposite for a downtrend, closing near the low.
So if the stochastic oscillator gets too high, it's like the stock is closing near the top of its range, which could mean the uptrend is running out of steam.
Exactly. And the reverse is true too. If it gets too low, it could be a sign that a downtrend is weakening.
Gotcha. So another tool to help spot those turning points.
Right. He gives examples of how to use it in mean reversion systems to generate those buy and sell signals.
So we've got a whole arsenal now for mean reversion trading. But before we move on, I want to go back to something you mentioned earlier, combining indicators and using your own judgment. Can you talk more about that?
Sure, one thing he's really adamant about is that no single indicator is perfect. They all have their quirks and can give you false signals sometimes.
So it's about understanding the limitations of each tool and using them together to get a better overall picture, right?
Right. He calls it confluence when you see several indicators pointing in the same direction.
Like getting confirmation from multiple sources.
Exactly. Let's say you see the RSI getting into overbought territory and the price is hitting the upper Bollinger Band. That's a much stronger signal than just seeing one or the other.
So it's like a jury of indicators.
Yeah, I like that. And he also says you have to consider the big picture too. Is the overall market trending up or down? Are there any news events that could affect prices?
So don't just look at the charts in a vacuum. You have to be aware of what's happening in the world too.
Exactly. He says the best traders can blend technical analysis, fundamental analysis, and their own intuition.
It's like being a market detective, putting all the clues together.
Love it. And he actually gives a lot of practical examples of how to do that.
This has been a great breakdown of mean reversion systems. Let's switch gears again and talk about those short-term trading systems, the ones that aim to grab profits from those small price moves that happen within a trading day.
Right. We're talking day trading, scalping. That's high-speed stuff. You got to have quick reflexes for that.
Definitely not for everyone.
Nope. It takes a certain personality and skill set to thrive in that environment.
Okay, so for our listeners who might be curious about this, what are some of the key things they need to know about these short-term systems?
Well, many of the indicators we've already talked about can be used, like moving averages, RSI, Bollinger Bands. It's just the time frame that's different.
So instead of looking at daily charts, you might look at hourly or even 15-minute charts.
Exactly. And he's very clear that the shorter the time frame, the more random noise you have to deal with.
Right, because those little price blips become more noticeable when you're looking at a shorter time period.
Exactly. So having a system that can filter out the noise is really, really important.
So how do you do that? How do you build a system that can handle all that chaos?
One key thing is to identify those support and resistance levels. Those are the prices where historically the stock has struggled to break through.
So it's like those battle lines where the buyers and sellers are fighting it out.
Exactly. He has a bunch of techniques for finding these levels. Trend lines, Fibonacci retracements, pivot points.
So you're basically mapping out those key zones on the chart and then looking for chances to buy near support and sell near resistance.
That's the idea. But he stresses that these levels aren't always super precise. They're more like zones where you're likely to see buying or selling pressure.
So you're looking for those zones, but then waiting for confirmation before you actually make a trade.
Exactly. And price action patterns are really important for confirmation.
Okay, so what are those exactly, and how do you use them in short-term trading?
They're basically formations on the chart that hint at whether the price is going to reverse or keep going in the same direction, like head and shoulders patterns, double tops and bottoms, triangles.
I've seen those. It's like the drawing little pictures on the chart.
Haha, yeah, they do. And he goes through each one and explains how to spot them. He's careful to say they're not foolproof, but they can help you see what's going on in the minds of the traders and maybe anticipate what's going to happen next.
It's like you're reading the market's tea leaves.
Right. And he gives a lot of examples of how to use those patterns for buy and sell signals.
Okay, so we talked about support and resistance, price action patterns. What else is helpful for short-term systems?
Momentum indicators, like the RSI and the MACD, they can help you spot those sudden bursts of energy that can lead to quick profits.
So it's about riding those waves of volatility
Exactly. But you got to be quick to react, quick to take profits.
because those opportunities can vanish in a flash.
They can. And he shares some good strategies for managing risk and making the most of those fast-moving markets.
Okay, so we've gone through a lot. Trend following systems, mean reversion, short-term systems, risk management, diversification, and all this psychology stuff too. But before we wrap up, I gotta ask, did the author have a favorite? Like, out of all the systems he tested, was there a clear winner that just crushed the others?
It's the holy grail everyone's looking for, right?
Yeah,
But the answer is no. There's no magic bullet that works all the time.
because the market's always changing. What works today might not work tomorrow.
Right. He makes that point really clear throughout the book. The real key is not finding the perfect system. It's finding one that you're comfortable with, that suits your style and how much risk you're willing to take.
So it's about finding the right system for you, not chasing some mythical perfect system that doesn't exist.
Exactly. And he walks you through how to do that. First, figure out your goals, how much risk you're comfortable with, and your trading style. Then you can start picking systems, testing them, and making them your own.
It's personalized, like a tailored suit.
Right. And it's not a one-time thing either. He says you should always be checking how your system's doing, making adjustments, and staying open to new ideas.
So it's a continuous process of learning and adapting.
Totally. And he provides a ton of resources like websites and software, even a community of traders you can connect with. It's pretty cool.
Wow, it's like a whole support system for mechanical traders.
It is. And that's one of the best things about this book, in my opinion. He doesn't just give you the info, he also gives you the tools and support to actually use it.
It's like having a mentor right there in the book.
Right. And I think that's something our listeners will really appreciate.
Okay, so to recap, we've looked at all these different types of systems: risk management, diversification, psychology, and how to find the right system for you. But I want to go back to something we touched on earlier, something really important.
Sure. What's that?
The idea that mechanical systems are more than just cold, heartless algorithms. They can actually help you learn about yourself as a trader.
Yeah, that really resonated with me too. The human element is just as important as the technical stuff, if not more important.
Right. You can use these systems to figure out your own biases, your tendencies, your emotional responses to the market, and become a more aware and disciplined trader.
And that process of building a system can be a real journey of self-discovery.
Mm-hmm.
Questioning your assumptions, testing your limits, pushing yourself to become better.
That's a powerful message. It's easy to forget that when you're focused on the technical side of things.
Totally. It's easy to get caught up in just finding the right formula or algorithm and think that's all you need. But there's so much more to it than that.
It's about mastering your own mind, realizing that your psychology can be your greatest asset or your biggest downfall.
Well said. That's one of the most valuable things I learned from this book.
Okay, so we've really gone deep on this topic, explored the technical aspects, the psychology, the philosophy.
It's been a fascinating journey.
It really has. Our listener has a lot to think about as they start exploring this world of mechanical trading systems.
Absolutely. And if there's one piece of advice I could give them, it's this. Don't be afraid to experiment. Try different things. Backtest, see what works for you. And remember, the self-discovery part, is just as important as making money.
That's great advice. I think that's a perfect place to leave it for today.
I agree.
It's interesting, isn't it? We started out talking about these mechanical systems, all the technical stuff, and we've ended up having this deep conversation about psychology, about knowing yourself, and finding a trading approach that really clicks with you.
It's true. We really have. We went way beyond the basics of like moving averages and all that. It's like these systems are a starting point for something much bigger.
Yeah, exactly. I think that's a huge takeaway for anyone listening. It's not just about finding the right system, it's about finding the right one for you.
Exactly. And that reminds me of what we were talking about earlier, those three trader personalities.
Yeah.
Trend followers, mean reversion traders,
Mhm.
and short-term traders. Even if you don't go full-on mechanical with your trading, just understanding those different approaches, seeing which one feels right for you, that can be a game changer.
It's like those personalities are different ways of looking at the market. You can try each one on and see which one gives you the clearest view, you know what I mean?
I love that. And even if you end up blending different approaches, just being aware of your natural tendencies can help you avoid making those impulsive decisions that can really hurt your trading.
For sure. So for everyone listening, think about what we've discussed. Which of those personalities resonated with you? What are your strengths as a trader? What are you not so good at? And what are you actually trying to achieve?
Yeah, those are great questions to ask yourself. And remember, even if you decide not to use a mechanical system, a lot of what we've talked about is still important. Risk management, making sure your data is good, the importance of backtesting, understanding your own psychology, those are crucial no matter what style you're trading.
Right. It's like we've given you a whole toolbox. You can pick the right tool for the job, whether that's a hammer, a screwdriver, whatever you need.
That's a great way to put it. And don't be afraid to get in there and try things out. Experiment. That's what makes trading so interesting. There's always something new to discover.
Well said. Thanks for joining me on this deep dive. It's been a really insightful and, I gotta say, fun conversation.
I totally agree. Always fun to chat with someone who's as into the markets as we are.
And to everyone listening, thanks for joining us. We hope you've learned a lot and that this has given you a fresh perspective on mechanical systems. Remember, the journey of discovering yourself as a trader is just as important as making those profits. Until next time, happy trading.